Hello and welcome. I'm Tan Suee Chieh, the President of the Institute and Faculty of Actuaries, and it's my pleasure to welcome you to the first event of our Finance in the Public Interest Seminar Series. This series has been generously supported by Hong Kong-based philanthropist and IFOA Fellow, Dr. Patrick Poon, and Milliman Consulting. Thanks to their support, we are able to host this event today free of charge to members and non-members. At the last count, there were almost 500 people tuning into today's webinar. I would like to extend a warm welcome to you all. I would like to spend 5 minutes to give some context to the inspiration of this thought leadership program before I introduce today's speaker, John Kay. Through our new program of events, which you can see on this slide, we want to bring thought leadership to the foreground of the IFOA once more. We seek to reposition the IFOA as a center of key societal debates, some of which are profoundly actuarial, whilst others reach out beyond traditional actuarial thought. We aim to cut through the noise, add to the debate, and move the conversation forward, and aim to build the IFOA reputation as an authority to execute our public interest duties. It is also in keeping with our growing desire within the profession to be more outward-looking, to be more forward-looking, to be bolder, and to move beyond the technical debates, to take our conversations to a higher level. I acknowledge a single swallow does not a summer make, but I hope this program and series of events will make a start to reposition the profession and extend our influence in society. We begin today with the Finance in the Public Interest series, which seeks to convene leading voices, economists and thinkers on finance to discuss what needs to change within our financial sector and our systems to ensure a more sustainable future for humankind. As you can see from the slide, we have distinguished guest speakers like John Kay, Paul Collier, and Andy Haldane. They will be joined by our own members and our own IFOA thought leaders, Louise Pryor, Ashok Gupta, Lucy Say, Nicole Espinal, and Nick Silver. The IFOA has been part of many responses to consultations, policy discussions, and public pronouncements over a wide range of issues over many years. Very often, they are technical and regulatory in nature and restricted to certain policy questions. There is now a growing realization that the problem confronting us is actually systemic and more entrenched, wider, and of a higher order. Too many things have gone wrong in our generation. Climate risks, biodiversity loss, accounting scandals, financial scandals, intergenerational unfairness, lack of economic income and health security, inequality, the poverty of the regions versus the metropolitan centers, financial exclusion. There is increasing public discourse that the philosophy, culture, and assumptions underpinning our economic models, financial systems, and regulatory arrangements have contributed to the existing crisis and the slow worsening of outcomes from a societal perspective. There is a need to change the conversation. The IFOA and the actuarial profession must be part of the new conversation. There are a plethora of issues for us to consider in this conversation. We will not be able to consider all of them in this whole series, let alone today. But it's important that we acknowledge them and see how they relate to one another so that we can fully appraise the scope and the relevance of the challenges and opportunities before us. From my discussions I have with the speakers in this series and from the work they have published, I have grouped what I consider to be the areas of focus which the actuarial profession can speak to. And I will just name the headings. 1, the purpose and the responsibility of the financial sector. 2, sustainability and the changes in economic thinking. 3, how we navigate from market capitalism to pragmatic capitalism. 4, pragmatism and the role of the profession. 5, an appreciation that all the problems we face are, or many of the problems we face today are wicked problems, and the need for listening, judgment, and wisdom. 6, culture and the ethical society. And 7, the role of IFOA and the actuaries at this very fundamental inflection point. I have provided you with a very quick context to the inspiration of the Thought Leadership Program and the Dr. Patrick Poon Presidential Series. So now I turn to introducing today's guest speaker, John Kay. John is one of Britain's leading economists. His interests focus on the relationships between economics, business, and the wider society. His witty and authoritative style has won a wide following for his books and articles, which have been recognized by numerous awards and prizes. His career has spanned academic work and think tanks, business schools, company directorships, consultancies, and investment companies. For 20 years, he wrote a regular column for the Financial Times. John has written extensively throughout his career to great acclaim. His books include The Truth About Markets, Other People's Money, The Long and the Short of It, and Radical Uncertainty, jointly written with Mervyn King, which was published in March 2020. Other People's Money was a book of the year for The Economist, Financial Times, and Bloomberg, and was shortlisted for the Orwell Prize for Political Writing. After the lecture, there will be a question and answer session. You can submit a question at any time via the online Q&A function on Zoom, and I will encourage all of you to do so. On that note, it is my great pleasure to present John Kay.
Thank you very much, and it's a pleasure to be with you. I've been asked to provide a trigger warning before we begin, which is that there will be strong language in what I have to say. The strong language, I should add, will not come from me. It will come from proceedings in the US Senate. So you may find it possible to tolerate it, but you may wish to cover your ears if you feel that you would be offended by hearing exchanges between Goldman Sachs and distinguished US senators about the events that gave rise to the financial crisis. With that preliminary observation, let me repeat what a pleasure it is to be here. And to begin by telling you that it's easy for me to visualize a parallel world in which I might have been an actuary. When I was a boy in Edinburgh, I was a boy actor on various occasions. And one of the plays in which I was featured was Samuel Beckett's Waiting for Godot. Those of you who know this play, which is for good reason regarded as part of the theatre of the absurd, will know that it is about two tramps who stand in front of a tree waiting for Godot, and Godot never comes, but at several intervals during the play, a small boy comes with messages allegedly from Godot. As it happens, Vladimir, one of the tramps, had a day job, which was not as a tramp, but actually was chief executive of one of the major Scottish insurance companies. And it was as a result of meeting him that I got the first paid work I ever undertook, which was in 2 successive years in school holidays. I sat in the actuaries room, the trainee actuaries room in Charlotte Square in Edinburgh and St Andrews Square in Edinburgh, and helped calculate surrender values. I went on to school, to university to read mathematics with a real possibility I might become an actuary. But in the course of my work at university, I discovered economics and decided that was the subject I wanted to pursue. I might have done better, at least for a bit, to have stuck with mathematics, because of course, subject of economics was becoming and is increasingly mathematical. A large part of that was finance theory. That was part of the way economics was developing in the 1970s. And it was something I learnt, I taught, and played a rather small part in actually helping to develop. But when I next encountered actuaries, not masquerading as tramps, very far from it, it was when I became a trustee of my college staff pension fund. And I was presented with actuarial reports and was startled to discover that actuaries knew nothing of the finance theory which was then being developed by economists. I was amused, astounded, rather shocked by that. But the world has changed dramatically since then. And I believe today that if anything, actuaries know not too little about modern finance theory. They know, if anything, too much, and take it rather more seriously than I do, for reasons which I will explain in the course of this talk. My next contact with the profession was actually when I went to the Institute for Fiscal Studies to set that up as a research-based think tank. And one of the issues which we looked at was the state earnings-related pension scheme, as it then was. And we modeled that, and we established that not only was it going to be very expensive, but much of the expense came from features which were not at all central to its main design. I discovered then that many actuaries rather resented the fact that people who were not actuaries should do modeling in areas that related to pension funds. And I remember giving a talk about the work we were doing to see in the front row stern-faced looking people in suits from the government actuaries department. But actually, we quickly established a rather good relationship with them and took advantage of the fact that we were free to say things about public sector pensions that the government actuaries department was not likely to be permitted to say. And that was greeted ultimately with a good deal of success when in the mid-80s, that scheme was radically cut back. I then went and established an economic consulting business. And one of the ideas I had for working in these areas was that we might develop models of the ways in which pension liabilities affected company balance sheets. It was in fact a good idea, but it was an idea I think we had perhaps 10 years too soon. But my next experience of dealing with actuaries was when I worked after the Lloyd's insurance market got into difficulties in the late 1980s. And that prompted me to ask questions about the nature of risk transfer. As you all know, Lloyd's originated in the 17th century in Thomas Lloyd's coffee shop in the City of London. But I discovered at that time a book by Michel Albert, who was actually another chief executive of an insurance company, AGF. He wrote a book in 1991, the time I was doing that work, called Capitalism Contra Capitalism, Capital Against Capitalism. And he talked there about the contrast between what he described as Rhine capitalism, which was essentially the French-German model in which large businesses were seen largely as social institutions, and an Anglo-Saxon model in which large businesses were essentially creatures of their owners, shareholder-oriented, placed in a market economy. He described that in an interesting way by talking of his own industry, the origins of the insurance industry. And he talked about the origins of the insurance industry in the 17th century. Now, the 17th century was a critical time for a great many of the things which we are talking about today, because there were two developments in the 17th century which not at all coincidental. They occurred at about the same time. One was the development of what we would regard as modern insurance, and the other was what we would know of as the theory of probability. And that coincidence came about really as the result of an Enlightenment project in which people ceased to talk about chance and fortuna and realized that it was actually possible to think about unexpected events in a systematic and scientific way. Albert described the two origins in the 17th century of the global insurance industry. One, could we have the next slide, please? Next one after that. One was in Switzerland, where, as he described it, groups of villagers would get together to agree that if one of their cows died, the village would club together to pay for a new one. The second origin was in Lloyd's coffee shop in the city of London, where gentle English gents would gather to gossip and to take bets on almost everything, bets including the state of the tides and the likely arrival times of various ships. So that insurance, in his description, and there's some truth in this, had its origin in two different ways. One was as a method of mutualization, of socializing the consequences of risk. The other was a mechanism of gambling. And that has remained true ever since as the two types of markets in risk which we have in a market economy. Trade in risk can serve one of two functions. It can either be people taking different ideas of the same events, or it can be ways of mutualizing, sharing risks of various different kinds. So that was how insurance began in the 17th century. At the same time, the systemization of probability began in the 17th century. It was generally thought to have begun when a French aristocrat called the Chevalier de Meer consulted Blaise Pascal and Pierre Fermat, two distinguished French mathematicians, on whether they could help him make decisions at the gambling table. And in the summer of 1654, Pascal and Fermat came up with the basics of what we now think of as the theory of probability. They found an answer to what Chevalier de Meer called the problem of the points, which was essentially the first application of what we now know to be Bayes' theorem. So that we had, in this sense, a basis for thinking in a systematic way about risk and probability. That was quite rapidly extended out of the gambling room into real events. There's a man called John Grant who went round the graveyards of the city of London, noting the dates of death. And that began the compilation of the first mortality tables, which were actually further developed when the Royal Society paid Edmund Halley, who's famous for his comet, paid Halley to go and study the rather detailed records of the Polish city of Breslau and construct the first mortality tables, which were in due course to be adopted by the Actuaries and the Scottish Life Insurance Office, where I spent my first work. But I was thinking about all of this in connection with the Lloyd's insurance market and the problems which had arisen in that market during the 1980s. Lloyd's had migrated, of course, from being English gents gambling in a coffee shop to being a serious, it had its origins in the marine insurance that came out of that gambling. But business was insurance much of it concerned still with marine insurance. But what had happened in the 1980s was that aggressive marketing had attracted a great many new players to underwriting in that particular market. And the result of that was that in large part, that market had moved from being the Swiss model, that is the mutualization of risk, the world in which people took a slip and carried it round the different underwriters in the room at Lloyd's in order to get each to take a part of a particular risk, to one in which people were trading risks with each other. There are two exchanges with Lloyd's underwriters which were really burned in my mind as a result of that experience. One was when I heard one of them denouncing in certainly profane terms some of the incompetent people who had brought the market to its knees in the late 1980s. And I asked, so why didn't you blow the whistle on these people? Why didn't you take some action? And he looked at me with a degree of incredulity and said, but these people were willing to take on risks from me at a price at which I was ready to sell, very ready to sell them. That is, it had become less about the insurance market and more about the gambling, the risk transfer market at that time. Second thing that burned itself on my mind was that another one said to me, you know, there are two things we can do very well from this institution. One is we can talk about the completely idiosyncratic one-off risk and analyze what is going on here. The other thing we can do is work where there are large, stable data sets, as with motor insurance, for example. It's the area in between, he said, that causes all the problem. And I'll come back to that area in between as the one which is described by the term radical uncertainty, which Mervyn and I chose to write about. There was another development at about that time. I was engaged in the consulting business then, which gave one a wide range of rather strange assignments. Another one took me round all the London upmarket casinos in the course of one single, rather extraordinary night. Some of you may know that London is one of the 2 or 3 centres in the world for very high level, very high rolling gamblers. It's where the kind of people for whom if they lose several £100,000 in the evenings gambling, it's not something that particularly bothers them. So that, and what surprised me about that particular evening was that there were these very rich people there, but they were not actually, as far as I could see, having fun. They were sitting there white-knuckled, wondering how the roulette wheel would spin or the cards would fall. And as I came back from that evening and thought about it afterwards, I asked myself, who were the people who were in these casinos? And the answer was almost without exception that they were high-rolling, highly successful, entrepreneurial business people. I thought to myself, how is it that successful entrepreneurial business people can believe they're going to win at roulette? And not only believe they're going to win at roulette, but go on believing they're going to win at roulette when experience shows that they don't. And then I realized that there was an explanation for that, which was that was the personality type of the successful entrepreneurial business person. That these were people who had taken foolish risks in their lives and for whom these risks had actually come off. In other words, I came to see that kind of irrational attitude to risk-taking was not only widespread, but it was actually a critical part of the dynamic of a market economy. At the same time as the insurance world was developing, the world of probabilistic reasoning was developing too. I've described how Grant and Halley developed the first mortality tables that became the basis of insurance. There was then a realization of the need actually to separate out gambling from insurance, because gambling in places like Lloyd's was not just about the fate of ships. It was about the fate of the king, the health of people, and that created the rule that you could only have an enforceable contract if it related to some sort of insurable interest, a rule which has remained, broadly speaking, in English law until the 21st century. It took one to a classic case in the early 90s, a classic case in which the Carbolic Smoke Ball company was sued by Mrs. Carlyle because the Carbolic Smoke Ball company advertised that if you used one of their products and caught flu, you would receive £100. Mrs. Carlyle used the smoke ball, caught flu, and claimed the £100. The smoke ball company refused to pay, and it was then defended in court proceedings by a distinguished team of lawyers, including future Prime Minister Herbert Asquith. Asquith put the argument that what was being offered was not a contract, but a wager, that it was a bet that Mrs. Carlyle would not actually get flu. The judge put that to one side and said a wager is where two people take a different view of the outcome of an uncertain event, and that uncertain event is what leads to the inclination to people to gamble. That opinion became important. Could we go forward a number of slides now at this point, please? I'd like to go to the one headed the Greenspan era. Sorry, I've got these slides slightly in the wrong order. This is the Carbolic Smoke Company became important in the 1990s when credit default swaps were invented. Because the issue was whether credit default swaps were gambling, in which case they would have been taxed and regulated as if they were gambling contracts, or whether insurance, in which case they would have been taxed and regulated as if they were insurance contracts. The International Association of Securities Dealers in London took counsel's opinion on this from a distinguished London QC called Mr. Potts, who presented the Potts opinion, which was, as they hoped, that these contracts were neither gambling nor insurance. That meant they were not taxed and regulated on either basis, and indeed were free of tax and regulation. The result of that, of course, was that these contracts could legally be made under English law, and that prompted the United States to pass the Commodity Futures Modernization Act that legalized them in the United States as well. But what were credit default swaps? This slide refers to a famous meeting at Jackson Hole in 2005, in which there was an argument about that. The man on the right is Raghu Rajan, who was then chief economist of the IMF and ultimately then became governor of the Central Bank of India. The man on the right is, of course, Alan Greenspan. And the argument at Jackson Hole was that Rajan presented a paper in which he said that credit default swaps and similar devices involved people taking on very long tail risks, which they did not properly understand, and that the world would end, this development would end in tears. Rajan was denounced at that event by a whole range of people, including particularly Larry Summers, who would subsequently be US Treasury Secretary, and a prominent figure during the crisis of 2008, who said that Rajan was a Luddite. What was going on was that risk was being socialized more effectively than it had been in the past. What was going on was socialization of risk rather than risk trading between people who didn't understand it. So that tension in risk markets between what is gambling and what is insurance had continued ever since. And of course, we know what happened in 2008 when we learned that much of what had been going on was that risks were being taken, passed on as they had been in the Lloyd's insurance market from people who didn't really understand them to people who understood even less about them than the people who'd framed the products in the first place. So let me go back, if we can go back a number of slides. I'm sorry about the order here. Yeah. Right, go back one more to the history of risk and probability. Thank you. The theory of probability, as I've described, came into being in the 17th century. It was developed effectively in the 18th and 19th, until by the beginning of the 20th century, probability was being used in a whole variety of different areas, in industrial process control, for example. And the theory of classical statistics was then developed, applying probabilistic reasoning in a whole variety of different areas. That mathematical formulation, which had begun in the 17th century, was being much more widely extended. But there were people who had doubts about this extension. And there were two books published precisely 100 years ago, one by this man, who is Frank Knight. And these books distinguish between risk and uncertainty. If we could have the audio, please.
A measurable uncertainty, or risk proper as we shall use the term, is so far different from an unmeasurable one that it is not in effect an uncertainty at all.
That was Frank Knight. And the second book was by Maynard Keynes. This was just as Keynes was becoming well known and hitting the scene with his famous economic consequences of the peace. Next slide, please. Audio, please.
By uncertain knowledge, I do not mean merely to distinguish what is known for certain from what is only probability. The sense in which I am using the term is that in which the prospect of a European war is uncertain, or the price of copper, or the rate of interest in 20 years hence, or the obsolescence of invention, or the position of private wealth owners in the social system in 1970. About these matters there is no scientific basis to form any calculable probability whatever. We simply do not know.
So Knight and Keynes together both wanted to make a sharp distinction between risk and uncertainty. Risk as being what could be described probabilistically, and uncertainty as things for which no probabilities could be framed. But that position, which was pretty much established in the 1920s, was challenged first of all by Frank Ramsey, a colleague of Keynes's at King's College, Cambridge, and then most powerfully by a group of Americans in the course of the 1940s. Von Neumann and Morgenstern on one side, and Friedman and Savage on another, argued that one could apply probabilistic reasoning to any kind of risk-taking, whatever. And that one could use subjective probabilities, as they described them, to describe any sort of uncertain event. That was their argument. And indeed, it was an argument that was made so strongly that by 1956, Milton Friedman one of the people who framed that theory at that time could say, could we go on to slide 8, please? And hear the audio. Hello? Audio?
In his seminal work, Frank Knight drew a sharp distinction between risk as referring to events subject to a known or knowable probability distribution, and uncertainty as referring to events for which it was not possible to specify numerical probabilities. I have not referred to this distinction because I do not believe it is valid. I follow Jimmy Savage in his view of personal probability, which denies any valid distinction along these lines. We may treat people as if they assigned numerical probabilities to every conceivable event.
It's impossible to exaggerate the effects of that and the extent to which that belief underpins both modern finance theory and large parts of modern macroeconomics. It is absolutely fundamental to a great deal of modern economics, and in particular to the ways in which finance theory developed from the 1950s on. That distinction between the abolition of the distinction between risk and uncertainty, the claim that all kinds of uncertainty could be described probabilistically. That's a claim which is strongly asserted in much of modern economics. And yet it's a claim which we believe is almost completely erroneous. Could we go to the next slide, please? And play that.
On the day when I left home to make my way in the world, my daddy took me to one side. "Son," my daddy says to me, "I'm sorry I'm not able to bankroll you to a very large start, but not having the necessary letters to get you rolling. Instead, I'm going to stake you to some very valuable advice. One of these days in your travels, a guy is going to show you a brand new deck of cards on which the seal is not yet broken. Then this guy is going to offer to bet you that he can make the Jack of Spades jump out this brand new deck of cards and squirt cider in your ear. But son, do not accept this bet, because as sure as you stand there, you're going to wind up with an ear full of cider."
This is Marlon Brando in Guys and Dolls, who explains precisely the reasons why it would be foolish in the context of finance to attach probabilities to every uncertain event. It would be foolish because information is widely dispersed, not equally held by different people. And if you are taking a bet, it is very likely you will be taking that bet with someone who knows more about it than you do. That's why, in Brando terms, you are likely to end up with an earful of cider. We need, I believe, to think about risk and uncertainty in a rather different way. And I want to describe briefly, in coming to the end of what I have to say, the ways in which Mervyn King and I have suggested we do it. Could we move now to slide 17? Part of the problem, we believe, sorry, I'm going to miss out the profane language, but we'll have an opportunity perhaps to discuss that later. When we talk about uncertainty, we use terms likelihood, confidence, probable, and probability. I want to assert that these terms are conflated in typical ordinary usage today, but they actually mean different things. Let me take an example, which one of a number of examples we use in the book. What is Philadelphia the capital of Pennsylvania? That's something to which it makes no sense to attach a probability. Philadelphia is either the capital of Pennsylvania or it's not. And this is a known and knowable fact. It may not be known to you, but there can be no question, and the Guys and Dolls slide extract illustrates that. It's not a matter on which it would make any sense for you to take a bet, because it's very likely that you will be taking the bet with someone who actually knows more about it than you do. It's likely, it makes entire sense to say it is likely that Philadelphia is the capital of Pennsylvania, because there is a general rule that the capital of a state is very often the largest city in the state. In the case of Philadelphia, it happens it isn't. And the capital of Pennsylvania is Harrisburg, not Philadelphia. But it makes perfectly good sense to say it is likely that the capital of the state is Philadelphia, even though in fact it is not. Likelihood is an application of our general knowledge of the world. And it makes sense to think of likelihood as an ordinal variable, but not a cardinal one. That is that something can be more or less likely, but not 10 or 20% more likely. That makes no sense. Secondly, there's a question of how confident we are in our judgments. And that's a subjective matter. And we all know that there are people who are highly confident in their judgments, whether they know much about the subject or not, and people who are not confident, even about matters about which they know a great deal. So likelihood and confidence are different. Probable is often used synonymously with likely, but probability is something that can be derived in one or other of two ways. It can be derived from a known or observable distribution, or it may be derived from the odds people will accept in order to bet. So let's note these words, likelihood, confidence, and probable or probability, and note that actually they have different meanings and they should have different meanings. And yet you will find, good example would be the reports of the International Panel for Climate Change. You discover that these words are used essentially interchangeably, and in a great deal of discussion of uncertainty, they're used interchangeably. Let's take the next slide and look at these things in a rather different way. Uncertainty, as I've described, comes from imperfect information. Uncertainty we may be uncertain about the present. Is the man in or we may be uncertain about the future. Some uncertainties are resolvable. They're resolvable either by finding out more information, which we describe as knowable but unknown, or they may be resolvable by probabilistic reasoning, which can be derived from some underlying stationary distribution, as with mortality data, for example. Radical uncertainty, on the other hand, is uncertainty which is not resolvable in one of these ways. It's not resolvable because the problem we're describing is ambiguous and vague. It may be not resolvable because not all outcomes are known. And most importantly, they're not resolvable because there isn't some stationary or non-ergodic ergodic process that gives rise to the observation, the data from which our probabilities can be derived. That is, radical uncertainty is what happens when we're talking about what will essentially be unique events. Radical uncertainty, for example, is exemplified by the current coronavirus pandemic. Mervyn King and I actually say in the book, it is likely that the world will be affected by some virus which does not yet exist, a pandemic that the world will be affected by a pandemic caused by such a virus. We say it's likely, not because of any great prescience. We certainly didn't know at the time that such a virus would break out in Wuhan in December 2019. And it would be meaningless to try to attach a probability to such a virus breaking down at any particular date. That's why it's important to distinguish what is likely from what has a probability. And the outbreak of a pandemic of that kind is the product of a non-stationary process which cannot be described in these kind of probabilistic ways. So the world consists of uncertainty, and some of which is resolvable and some of which is radical. And we can deal with radical uncertainty only in rather different ways. How do we actually manage radical uncertainty? Well, we want to restore, but in slightly different terms, Knight and Keynes' distinction between risk and uncertainty. Because if you talk to ordinary people and ask what they mean by risk and uncertainty, they will just make a distinction. Risk is almost something that is always undesirable. You never hear people talk about risk in terms of the uncertainty attached to good events. No one ever says there's a risk I might win the national lottery. They don't even say there's a risk I might not win the national lottery, because they don't really expect to win the national lottery. What risk means in ordinary language is a threat to some reference narrative, a threat to what it is they think is likely. People frame what we describe as reference narratives. It's the scenarios on which they plan their lives, whether it's personal life, their business life, their financial life, and risks are the kinds of things that jeopardize that. And the ways in which we actually handle risk effectively in real life is by building strategies that are robust and resilient to these kinds of risks. And that's a very different approach to the one that believes we can predict the future by describing things quantitatively and probabilistically. In other words, the extension of finance theory, which we've described, took finance theory far beyond the areas in which it was actually useful. And that's exemplified famously in 2007 as the financial crisis broke. David Viniar, who was then CFO of Goldman Sachs, said, "We've experienced 25 standard deviation events several days in a row." Now, you don't have to know very much about statistics to know that it's almost inconceivable that you will ever experience 25 standard deviation events, far less several days in a row. What he meant was that the Goldman Sachs models failed to describe the situation which broke out in 2007. And they failed to describe it because the data on which they had been based was the product of a non-stationary, non-ergodic process which can change constantly, and that they could not derive things from that kind of basis. Similarly, in 2010, 2 years later, Barack Obama was sitting in the White House deciding whether to order the raid on the Abbottabad compound, which culminated in the killing of bin Laden. There was much debate in the White House as to whether the man in the compound was bin Laden or not. And US intelligence agencies had been told after the intelligence failures of the Iraq War that they had to express their judgments in probabilistic terms. So they did. And Obama was presented with estimates of the probability that bin Laden was in the compound, which ranged from 25% to 95%. And at the end of it, he said, "Look, guys, it's a flip of the coin, isn't it? It's 50-50. By which we're sure he didn't mean the probability that the man in the compound is bin Laden is 0.5. What he meant was that they did not know whether the man in the compound was bin Laden or not, and he had to make a decision anyway. That is radical uncertainty. That is handling genuine uncertainties, which are where the outcomes are the product of non-stationary processes and where probabilistic reasoning is simply not applicable. The necessary approach in that case is, as I've described, to build a strategy round about your planned raid, which is robust and resilient and enables you to manage things that work out as you didn't anticipated and abort the process if it seems to be going wrong. If I can have my final slide now, please. Risk is almost always undesirable. Uncertainty can be either good or bad. Uncertainty is what actually makes life worthwhile. The uncertainty that's entailed in going to new places, meeting new people, having new experiences of all kinds. Uncertainty, as I described earlier, is actually something upon which we thrive. Uncertainty, and this was the argument Frank Knight presented in his case, uncertainty is actually the fundamental dynamic of capitalism. It's uncertainty that gives rise to probabilistic, to uncertainty that gives rise to profit opportunities. Uncertainty of this kind can't be described probabilistically. What we need to do in our lives, our businesses, our finances, is to make again that distinction between risk and uncertainty, manage risk and embrace uncertainty. And since I'm enjoying using movie clips in all of this, I will use this one to summarize that particular sentiment. Audio, please.
In Italy, for 30 years under the Borgias, they had warfare, terror, murder, and bloodshed, but they produced Michelangelo, Leonardo da Vinci, and the Renaissance. In Switzerland, they had brotherly love. They had 500 years of democracy and peace. And what did that produce? The cuckoo clock.
Thank you all very much.
Thank you, John, for such a engaging, accessible, and important lecture on the distinction between risk and uncertainty. Yeah? I enjoy your book, with Mervyn King, Radical Uncertainty, and I believe it is required reading for the profession. Yeah, but I wanted to ask something which is at the heart of the issue. Yeah, because our whole financial edifice and the way we quantify risk capital, the way we manage our risk frameworks, which emanate from our regulators to the profession. And I wondered whether even in our syllabuses, whether we actually teach the idea of uncertainty. I wondered, yeah. And that is really at the heart of finance in a public interest series, right? You mentioned in historical terms about your beginning at Edinburgh. And I can recall, certainly in those years, in the 70s, 80s, and 90s, we have a concept of the appointed actuary, but the models were highly deterministic. And the exercise of judgment was part of the toolkit. And I'm not defending that is the right answer. But at the turn of the century, the advances of financial economics, and that was well documented elsewhere, the profession was slow to embrace the thinking of stochastic processes and financial economics, which is at the heart of modern financial theory. And they are all based on probabilistic systems. And my sense is that our current work is very much dominated by that. But that is missing a very big piece, according to your book and your lecture, on non-systemic, on radical uncertainty or on Knightian uncertainty. So maybe you could help me, help us unpack this, whether my analysis is correct, and where do we go from here if our financial edifice is based on something which is clearly, in your argument, incomplete?
Yeah. I think we have to distinguish, and I make this distinction again, between radical and resolvable uncertainty. And the main categories of resolvable uncertainty with which we are typically concerned are ones where there is some underlying stationary distribution. So that mortality, for example, it was one of the earliest examples of people finding a relatively stationary distribution and making use of that. So mortality tables have this kind of objective basis of probabilities. On the other hand, in a lot of standard actuarial modeling, we're combining that with assumptions about investment returns, which are not the product of any underlying stationary process, and therefore cannot be described probabilistically in the same way. What we need to do is be making that distinction between outcomes, ergodic processes, where the outcomes we observe are generated by some sort of process that remains relatively constant over time, and ones where the outcomes we observe do not have this property of ergodicity and therefore cannot be analyzed in these kind of ways. And some of the things with which you're concerned fall into one category, others fall into the other. Will you give one example, which is to say, of an extraordinary success of mathematical modeling, for example? How is it that NASA could send a probe to Mercury, and it took 8 years to get there? And when it did arrive there, they could nudge it into an orbit around Mercury in exactly the position they'd predicted 8 years earlier. They could do that because the motion of the planets is well understood, and as the equations of motion have remained constant for several hundred years. They could do that because the motion of the planets is unaffected by what we do to it. And they could do it because the motion of the planets is unaffected by, and the trajectory of the rocket is unaffected by what we think about it. But none of these things, the absence of reflexivity, the independence of outcomes to our beliefs, and the underlying stationarity of the determining equations, none of these things are true of most of the processes we have in business and finance. And therefore we can't apply this kind of modeling with the same degree of confidence or precision that we can do in cases like the problems with which NASA has to deal.
Thank you. One of the questions are now coming in, quite a few questions coming from the audience. I would like to remind the audience that the webinar is recorded and it will be put on our website. So if you may want to name yourself and which organization you're from, but you can also choose to be anonymous. There's a question about you talk about radical uncertainty, but actually there is also an economic context, yeah, because you mentioned about Friedman and Keynes, yeah, and to what extent do you think that the historical and political context influence the kind of economic theories which are being adopted? It's not well known that, to me anyway, that Friedman made that comment about the convergence of uncertainty and risk, and he see that as one similar thing. One is subjective and the other one is less subjective. But he's well known for his belief that freedom and capitalism and market capitalism should be left as a best form of economic system. So I was wondering whether you could comment if that actually it's partly about risk and uncertainty, but it's also about economic and social context, because currently there's less emphasis on self-interest and probably a bit more emphasis on collective interest.
Yeah, I think that's a really important point. And it's part of the reason why I tried to weave into what I taught, that Albert distinction between Rhine capitalism and Anglo-Saxon capitalism, and the way in which the trading of risks can have the two motives, the socialization of risk, or the gambling type motive of passing it on to people who know less about it. And I think it is absolutely right that the ideology, the political ideology, which became dominant in the 1980s, was one that supported that Friedman was associated with that Friedmanite approach to the way we're thinking about risk. And that's exactly what was going on at that Jackson Hole conference, where the dominant strand of thought in it was the free market one, which said people were trading these complex securitized products because this was a way of managing the risk more effectively. Whereas the contrary position, which was vindicated by events, was essentially the one that said what was going on was people who didn't really who understood a bit about what they were doing, were passing risks over to people who understood even less.
Okay, there is a question from Martin White, which I want to ask, partly because it's related to the conversation we have been having. In terms of the narrative, which takes us to the Jackson Hole conversation and a few years after the financial crisis, is described in your book, I think, called American Business Model or the Washington Consensus. Yeah, and that has been challenged in the last 5 to 10 years. But those assumptions still underpin our financial regulation. I believe the way value at risk are calculated, short-term risks are calculated. It doesn't have take into account long-term sustainability and issues like that. So there's a question from Martin White on financial regulation, the prudential regulation of banks. You have suggested that detailed rules are less important than structures and relationship. Detailed rules may be inspired by financial theory. Is this what we should be focusing on? And I think I'm familiar with Martin's thinking. And one of the things is that we just read today, there is a news release from the Bank of England that they will have more rules instead of regulations on financial regulation. Maybe you could take that. So is rules the answer? If they are not rules, what should we be issuing, right? In terms of guidance, yeah.
Yeah, I mean, the financial crisis of 2007-8 was a pretty comprehensive demonstration of the inadequacies of value at risk modeling. Mervyn rather forcefully cited in the book the case of Northern Rock, which in the spring of 2007 was described itself correctly as the best capitalized bank in the UK, and was in process of attempting to return capital to shareholders. And that was 6 months before a run on the bank led to its collapse and required it to be bailed out by the Bank of England. So that value at risk modeling proved entirely inadequate. And why it's interesting to take that case a bit further and ask why it proved entirely inadequate. The reason was that it was not anticipated that wholesale money markets would for a period dry up in the way they did 6 months later in that year. That was simply a risk which had not been identified and not taken into account, was not in the historic data set that gave rise to the analysis which led to the prescribing of risk weights in these particular ways. So 2 points there. The first is one of identifying risks, which may be quantitative or may be qualitative. That one was essentially qualitative. It's would institutions develop in a way that made the historic assumptions become untenable. And that was what happened, and they did. You asked the question, was your strategy robust and resilient to that particular development? No, it was not, because Northern Rock's business strategy depended on being able to place mortgages in wholesale securitized markets within a few weeks after the creation of these mortgages, and there was no attempt to create a strategy that was robust to the failure of that particular assumption. It's back to the way in which we should think about risks, not by believing we can derive models from historic data sets, but by asking what could go wrong with our particular strategy, and to what extent is it robust and resilient to that. But unfortunately, as you're describing, what we've done is to complicate still further the value at risk calculation, rather than understanding the fundamental weaknesses of that kind of approach to regulation.
I think there are many levels of issue at play here. I want to push a bit slightly in this area about risk models, which is still the foundation of our financial regulation, right? But increasingly, you're saying that we should have more qualitative discussion. I think in your book, you talk about abduction, you talk about judgment, and you talk about big world thinking. Is it beginning to happen, or are we still stuck in the modeling work? And I would not be too critical of the risk models, because at one level that is necessary, but that is not sufficient. But is the conversation on judgment and on what's going on here by Ruffelt, what's going on here, is that conversation being asked in businesses and in government and in the professions?
I think we have this passionate desire in the modern world to quantify things, even things that plainly can't be quantified. I was reading just in the last few days what seems to me a striking example of that, which is a report on measurement of so-called natural capital and biodiversity. And the issues with which people are concerned, their species lost, climate change, habitat loss, and so on, are fundamental and important things for us to be talking about. But the idea that we can put numbers on them so that we can say, as they attempt to say, that the natural capital of the United Kingdom is 700 billion pounds and went up last year from 700 billion pounds to 710 billion pounds. These are just numbers which are being made up, plucked from the air, and which have no real meaning and no real significance, and are distracting people from the fundamental qualitative issues which they ought to be talking about. It's this, again and again, I think we see this kind of what we call bogus quantification, where people attach meaningless numbers to data.
I obviously agree with you, but I just wondered what needs to change to facilitate this, yeah? Because the requirements of regulation and the assumptions implied in measurement and in resilience and in capital capacity is based on quantitative measure, but clearly they are not, they don't describe the real world or the real value as 2x.
Yeah, I've done quite a lot of work on regulation in financial services, and I was looking at regulation in pharmaceuticals, which has raises very similar issues. In both are industries in which we obviously need to have regulation, but they're industries in which regulation has been pretty unsuccessful. And regulation of both these industries is at once extensive and intrusive, and yet not very effective, and largely captured by the industry itself, which has an excessive influence over the form of the regulation. What in both cases we need is to go back to something closer to where we were in part 50 years ago, which is where much of this regulatory activity is internalized within the firm itself. That is, so that in the end, the amount of capital a bank needs, the best judges for that are the people who are actually making the lending decisions within the bank. Similarly, the best people, people best placed to assess the risks associated with pharmaceutical products are the people involved in the departments that develop these products. What we need to do is, instead of writing more and more rules for these people to follow, rules which, as in the Northern Rock case, people will play with in order to operate at the minimum which is permissible. Instead of writing more and more rules, what we need to try and do is to give people the right kind of incentives to make the rules for themselves. That's the kind of thinking which I believe we need to approach in this area.
No, I like your answer. I'm going to take you slightly to a different area on products and then on anti-fragility. Peter Tompkins, his question was about asymmetry of information. And I think he's asking a leading question. Do you think enough is being done in the financial services to make transparency of investment costs a reality for the person in the street? I often say it is difficult enough for those qualified in finance. How much worse is it for the average citizen? Would like to speak to that. I think here is about opacity of products. It's about asymmetry of information. And the IFOA recently has also launched a campaign or a study into the risk transfer or the inappropriate risk transfer from institutions to individuals under the banner of great risk transfer. Because clearly all the risks are being transferred to protect the balance sheets of companies because products are capital inefficient or risks on defined benefits are being passed to the policyholders, which actually they are passed to people who know less about risk management. So maybe in answer to Peter's question, you could expand your answer about the man on the street, right? After all, the financial institutions and our sector really do have a public interest, right, to make sure that they have economic income and retirement security. So maybe you could speak to that space, John.
Yeah, there's a lot of questions bound up in that. I think in some ways the largest is the breakdown of trust, which we need to restore. I mean, most people do not want lots of information about financial products. And the people on this call, as you described, are people who are interested in such information and capable of absorbing such information. Most ordinary people for whom financial products are produced and sold are not able to, are not interested, and are not really qualified to assess them. What they want, as they want when they go to a doctor, is they want to be able to talk to someone they can trust. That's what the financial services sector has largely deprived people of doing. And actually, it's somewhat depressing to see the way in which it's moving in that opposite direction in medicine, in which doctors are being told not so much to advise what to advise, to do less in the way of advising their patients, and more in terms of giving them information to make their own decisions. In almost all areas of professional services, what you want is a professional you can trust who will help make judgments on your behalf, rather than a conduit for information, which is better supplied by the internet anyway. And in relation to costs of financial services products, I've spent quite a lot of time looking at the attempts to generate such kind of information. And I've concluded that the impossibility of identifying the costs of financial services products in some meaningly comparable form over different products. The complexity of doing that is just too great. You can't come up with a number that is the cost of a particular product. You have to understand better the strategies which are being adopted. And that's something you need a qualified professional who has some kind of fiduciary obligation to advise you on. You've also raised a separate question of the risk transfer to individuals, which has come from the collapse of defined benefit schemes in favor of defined contribution schemes. And I think that's one of the most disastrous things we've done in Britain in the last 25 years. And it's very largely the product of misconceived regulation, that by purporting to minimize the risks associated with defined benefit schemes, we've effectively eliminated defined benefit schemes in the private sector. That's a regulatory disaster, not a regulatory success.
Okay, I think we couldn't push that further because it goes fundamentally about measurement and how do we put capital aside, which we'll return shortly. But I want to take a slightly more psychological bent about from David Mack. Yeah, he asked about how do we encourage leaders to ask the right questions, right? How can leaders be encouraged to understand this concept when they persist in asking for risk to be expressed as a probability? And is it a function of personality trait, alpha male type? I'm not quite sure what he meant, but that's what he has written. Would you like to respond to that?
I guess it's just our obsessive demand for quantification. I mean, I think one aspect of the history, which I didn't spell out, was it's remarkably late in human history that probabilistic reasoning came into being, 17th century. We know that the people in ancient Greece and Rome gambled a lot, and the people in ancient Greece and Rome who were very good mathematicians, but people didn't actually formulate a theory of probability at that time. It's quite strange, and I think a large part of the reason for that is that people don't easily think in probabilistic terms. We're much more inclined, much more naturally, to think in terms of stories than in terms of probabilities.
Okay, that is a very rich area in terms of paradigms on how we process information and East and West attitudes towards analysis and synthesis. But I think we should pull back a bit. I want to record someone's comment. Paul King reminds me that our syllabus do make a distinction between risk and uncertainty. So thanks, Paul, for updating me. Because I qualified some 30, 40 years ago. The other question which I thought was useful, which is really an antidote to our arguments earlier on, and it's from Matthew Perman. And he basically says, if you don't have, if you don't have all these risk models, then we assume it's still a good idea for insurance companies to hold capital against rare events. But what would be a way to set capital if we don't use these risk models? Yeah, okay, we could have subjective assessment and ask what's going on here, but how do we capture? How do we set capital? Yeah, so it's a very practical question. And maybe I could link on to another question which I have earlier on, is that actuaries work with models, the relevant actuaries work with models every day. How can they incorporate uncertainty in the conversation they have in the boardrooms, right? And also in their management teams and with regulators. Maybe you could help us from your perspective.
I think this goes back in a way to what we were just discussing about people naturally think in terms of stories, not probabilities. And I'm very much in favor of people using models of various kinds. the mistake is to believe that models in some sense are true, that they give you the right answers, in the way people reasonably use models in physics in order to do it. This is the difference between NASA's models, as it were, and financial models. We should regard models as rather more as a way of telling illustrative stories, so that there are ways of trying out scenarios, saying how bad could it be, rather than things that are going to give us answers that will enable us to say the right amount of capital is X.
John, given the trail of the questions, there was something in the back of my mind, but we could return to it on Tuesday next week when we are joined by Paul Collier and Andy Haldane and Louis Pryor. It was about systemic thinking and also second order thinking, right? Because somehow it's the way we bring a particular way of processing into solving problems which are actually quite wicked, quite complex, and it lends itself to multiple analysis. I think you touched that in the books you have, but we probably could return you to that. But I want to go back to some of the more questions which have not been answered. This one is from Colin Wilson. And he says that in dealing with uncertainty, is it possible to move beyond resilience to anti-fragility?
Yes, so the anti-fragility is, can you actually benefit from uncertainty? And that's kind of what we're trying to say at the end with the sort of Borges quote, which is that, yes, it's uncertainty that creates profit opportunities, both in markets and in business. That there was no futures market in the iPhone in 1997 because people had not thought of an iPhone then. You can't have a probability of inventing the wheel because if you could conceive of a probability of inventing the wheel, you already would have invented the wheel. It's the adaptability that enables you to take advantage of opportunities as they arise. If one goes back to the iPhone story, there's a famous interview in which, when Steve Jobs went back to Apple in 1997, he was asked, so what's your strategy for Apple? What are you going to do? And his answer to that was interesting, which was, I'm going to wait for the next big thing. And the next big thing actually turned out to be the digitization of music. And what happened was that Apple took advantage of that to create the iPod. And then the iPod was built in with the other big things that were happening, which was basically messaging and social media, to create the product that combined the attributes of both. It was that kind of positioning oneself to be able to take advantage of unexpected opportunities as they arose, which was the basis of Apple's success. And that's very different from predicting the future 5, 10 years ahead.
John, that is a great story. It's a great story about Steve Jobs, and also actually it lends to Richard Raphael's, right? A good and bad strategy, the way he thinks about strategy.
That's right.
And it's not about maximization, like we seem to be so preoccupied with, right? It's about listening and the intuition, which underpins a lot of great decisions. But I'm really pleased with the number of questions coming in, but I think that to respect the time limit, I need to draw to a close. I will ask one final question, which I think certainly came to the foreground since the financial services, global financial crisis in the last 10 years, and also during the COVID-19 crisis, right? And it's about pay and incentivization of our senior executives in the financial industry, and whether it has gone a step too far, and whether it has driven the kind of outcomes we see in the industry, and maybe you can give your preliminary remarks on this, because I'm sure our good friend Paul Collier would have a lot to say on this as well.
Yep. I think we both have quite a lot to say, and I think we would say some of the same things. I think the rise of the bonus culture across business and finance has been is an appalling development. An executive, if one can take business executives for the moment, it's the idea that I need to be paid 5 million a year for turning up and another 5 million as a bonus for actually doing the job is absolutely ridiculous. And I remember thinking, I had a serious operation a couple of years ago, and I thought, if I'd put £1,000 in an envelope and said to the surgeon, if this works out okay, there's this bonus for you, he would have been rightly insulted, just as I would have been insulted if my students had said, if I could get a good grade in the exam, there's a bonus in it for you. People who are doing the jobs with this kind of responsibility should not expect to be paid in this kind of way. Now, the consequence of doing that, or offering that kind of pay, is we have attracted into these roles the kinds of people who are incentivized in this sort of way. That is, it's a self-justifying, it's a pernicious cycle which we've created. And the result of that we've seen in financial services. Bear Stearns famously had over its trading floor the slogan saying, "We make nothing but money." And we learned that in the long run, the firm that made nothing but money didn't even make that. It was torn apart essentially by the greed of its own employees.
John, I want to say thank you to you for such an engaging and enjoyable and productive session, which set the scene for the next 3 sessions. John Collier, as well as our own actuaries, and then the final session on Tuesday. And as an aside, I would really encourage the people who sign up, 300 odd people are listening in, to come tomorrow, because clearly the last question is about self-interest and collective interest, and how we could balance that, because we obviously have thrived under a free market system, but it must be a free market system which serves public interest. And how do we balance that? And there's a lot of literature of which you and your colleagues and co-authors have been at the forefront, but we continue to debate that, because it's not clearly about the things we do in our profession. So with that, I'd like to thank you, and I would like to say some remarks as I draw it to a close. Yeah. I'm finding the section where I basically talk about sorry about this. Okay, so really to repeat my thanks to Dr. Patrick Poon and the Milliman Consulting for sponsoring the events. And you can go to our website to see all the events. But for Finance for Public Interest, tomorrow is anchored by Paul Collier. And we can go into the last slide, Nikki. He's the professor at the Blacknick School of Government at Oxford. And of course, on Thursday, we will have our own Ashok Gupta, Nico Espinal, Nick Silva, Lucy Say, and Lucy Say. And next Tuesday, we will have John again, Paul Collier, Andy Haldane, and Louis Pryor, the president-elect, will be joining us. So I hope that you enjoy these sessions and that you'll come tomorrow and Thursday as we continue to engage one another and also external thinkers to lead us to a more informed position as to what the profession can and must do in response to the big questions of our time. I hope that you could find time to complete the feedback, which was sent to you as soon as this session closed, and so that we can make improvements for these events. So with that, I would like to conclude the session and thank all of you. Bye-bye.